Well, hello there, and welcome to Edge Trading. Look, I want to thank you, along with Rob Booker, for making the investment in this educational product. You almost certainly made the decision to make that purchase based on what you've seen from the TFL TV shows that Rob and I record daily, and have been for the last 2 months. And in those shows, you've seen us pick, many winning trades out of the market, and hopefully you've profited from following our sort of actionable market advice on a day-to-day basis. Well, the show's been running for about 2 months at the time of recording, and Robert asked me to put together an accompanying video course, if you like, that helps to put you in our mindset, to help give you the, if you like, an advantage or a steer before you ever watch a show as to exactly how we go about analyzing the market from a technical perspective and then trading that market profitably. And that's great. I think this is probably going to be a 10 hours worth of video, which if you can absorb the key concepts at hand, I promise you will put you on the right side of the market more often than not, and align your trades with the smart money. So I'm hugely excited to be given the opportunity to put this series together, and we're going to spend a bit of time together now on getting you ready to go. Now, frankly, when we look at the financial markets, we have to understand in the first instance that the financial markets are just like any other market for any other commodity that is tradable on the planet. And given that they are exactly the same, I want to start this series with the fundamental premise that underlines everything that comes after it. And if you can grasp this fundamental premise, you really will be well on your way. So let's get into that right now. Well, here you go. This is the fundamental premise that underlines everything that we do on TFL TV and underlines the philosophy of edge trading. And our key premise is that in any market, price is king. At any snapshot in time, price represents an agreement between buyers and sellers, the participants, if you like, in any marketplace. It doesn't matter what we're talking about. We could be talking about blue jeans, baked beans, motorcycles, houses. It just doesn't matter. What price represents is in any snapshot in time is the moment at which the deal is struck. It is the moment of agreement. It is the discovery of the agreed value for that traded commodity, product or instrument. Price is king. And by that way of thinking, price necessarily contains within it all that anyone needs to know about the agreed value of a given commodity, entity or instrument at any one moment in time. If you can accept the fact that price is king, you don't need to understand, interpret, argue about, debate the fundamental situation, if you like, the reasons for a given price. You can rid yourself of all of that nausea. If you understand that price is king, you have a real head start. Let me explain what I mean. You may well recognize this graph, this slide, if you like, from your economics 101 class back in high school. It is in its most simple form, the demand and supply curve for a given tradable product, commodity, entity or instrument. And what you're seeing there inscribed on the graph is the relationship between those entities, those market participants who are suppliers of or holders of that commodity, and those who might demand that commodity, within the marketplace. So what you can see here is that there is a relationship between price and quantity, or the amount demanded or supplied. Let's have a little further look at that. What we can see here is that as the market price, the agreed price of a tradable commodity rises, so suppliers will be keener and keener to offload, to sell, to trade, or to create that commodity, to supply that commodity, because the price is higher and the profit incentive is greater. And conversely, we can also understand that demand for that commodity is likely to drop at higher prices. And we can see here that at the highest price on the graph here, the quantity demanded is the lowest. Okay, and it's this fundamental relationship between market participants that results in the agreed price, the intersection of these two curves on the graph. We don't need to understand, why demanders and suppliers, buyers and sellers have agreed on the price of this commodity, have agreed to trade at this price. It's not necessary for us to understand that, but it is necessary for us to understand that at a given snapshot in time, price de facto contains all we need to know with respect to gauging the specific value of a given commodity. If the market is subject to oversupply, if supply exceeds demand, well, that would be represented by this area on the graph, and price would naturally fall to a point at which demand would then equal supply, and the price could be discovered or agreed. If supply falls below demand, represented on this area in the curve, we will see the opposite happen. The bottom line is the deal is struck here, where there is an agreement between buyers and sellers, demanders and suppliers, as to what fair value for that commodity is. Where does that lead us? Well, let's have a look. If we accept that price is king, we can make the following key deductions about trading any market. Firstly, we understand now that every market represents an ongoing discussion, debate or struggle, if you like, between buyers and sellers, demanders and suppliers, market participants, to agree on the fair value for an exchange of one commodity for another. It doesn't matter what that commodity is. Further, we can understand that price only moves as a result of an inequity between demand and supply, as you saw on our Economics 101 graph. What do I mean by that? Well, I mean that any increase in demand over supply, which outstrips supply, is going to cause price to rise. If you have more buyers than sellers, more demanders than suppliers, it follows that those demanders, those purchasers, will be prepared to pay increasing prices to satisfy their demand. Also, we can deduce that any increase in supply over demand is going to have the opposite effect, right? If there is a surplus of supply that outstrips demand, then suppliers are going to have to drop their prices in order to create the demand to satisfy that supply. Let's look and see how that looks in graph form. Now, this happens to be the weekly chart of the euro traded against the US dollar, but frankly, it doesn't matter. It could be a chart of any commodity, and all a chart is doing here is tracking the movement of price over time. Now, what can we learn from this? Well, we can see that at the beginning of the period that we're showing, price was at this point and fell, and fell and fell until we reached a price point at which demanders came back into the market, if you like. Purchasers came back into the market in sufficient quantity to push price back up. And we get to this point in the graph here, and we can see that for a short period at least, we had an outstripping of supply over demand, and that causes price to fall. Purchasers come back into the market at this point in the graph that I'm showing here, and that drives price back up. That is demand outstripping supply. And when we reach this point in the graph here, we can see that there is a rapid fall off in demand. There is an oversupply, and that provokes price to fall. But there's something else I want you to notice about this graph, and that is the moments at which price is turned. Now let's have a look at those, because it's interesting. So let's just plot a big red line through this price point, which happens to be 121, essentially 121. Okay, that's €1 dollar. Sorry, €1.20 for every dollar. We don't need to understand why this proved such an influential inflection point, but you can see very clearly that on multiple occasions 121 had the ability to turn the market. Okay, had the ability to turn the market. Let's see if we can find another one. I bet we can. And plot a line across price from the left, and we can see that once price rose to 143, we struggled. Okay, whilst we made a market top up here, that very definitely turned price back to the downside. We can see again that within this band between 143 and say 148, we certainly had the ability to alter sentiment. Okay, to reverse the prevailing sentiment. We need to understand why that is. Why did this particular price point come to represent a fundamental shift in sentiment that was meaningful enough to drive this equation between demand and supply the other way? What is that? Why? Well, the reason actually is very simple. The reason is because the market is made up of human beings, you and me. We are the market. We are the market. And human beings, being what we are, we remember key price points. We remember those price points, and those are the price points at which our estimation of fair value for a given commodity is called into question. And that is why these key price points are relevant. They're relevant because people remember. I mean, look what happens when price falls down to .85. We can see that it's just impossible for the market to break lower than that because there's too much demand for supply to satisfy that demand, and that's what provokes the reversal in sentiment. Let's have a look. So price falls down, and there's absolutely no support for that commodity. Doesn't matter what that commodity is until we reach a price point at which sufficient purchasers come into the marketplace and demand it. And that's remembered over the course of about 3 months. Finally, demand outstrips supply, and that provokes the rise. And exactly the same at the top of the market, right? As I've said before, 121 was clearly a key point. When demand exceeds supply at that level, up we climb, and we make a new high at 160. Okay, that proves again it holds for a month or so. Okay, but when the market finally agrees that this commodity is overpriced, down we come. Okay, and we don't really stop until we meet 121 again, and that status quo is questioned. Okay, so this little exercise enables us to make further deductions about a market. We've seen here that market participants, because they're human beings, seem to remember price points that were significant in the past. And hey, listen, let's look at any other area of our lives. Where we look at any marketplace, whether it be for food or white goods or motor cars or houses. We know instinctively. When we look like we're getting a bargain price. When price is falling, where the price points at which we want to enter the market, and we similarly know when something is overpriced. It's exactly the same in the financial markets. Market participants remember where these key price points were. These price points that were significant in the past, and because of that, these key price points are where prevailing sentiment is going to be challenged in the future. And the result of this challenge is often a reversal in the prevailing sentiment and order flow, and that is what materializes to us in a reversal in the movement of price. I mean, it sounds so straightforward when we look at it that way, but understanding that is absolutely is critical. The markets that we trade, whether they be forex, commodities, indices, it just doesn't matter. They are markets, nevertheless. They represent this ongoing struggle between buyers and sellers, between demanders and suppliers, between market participants to understand what the fair value for something is. And only when they agree can a deal be done, can an exchange be made. Well, markets being made up of human beings, they remember where key price points were in the past, and that is why they are significant in the future. And that's the founding principle of any technical study of the markets. Well, boom, there you go. That's our starter for 10. And I want you to remember that that fundamental premise on which everything that we're going to hit is based, and that is that price is king. Okay, so in our next lesson, we're going to dive deeper into that theory and start to understand what it means to us in practical terms. See you again.